India versus China economy comparison. Key facts: the global economy is changing fast, and the battle between India and China is getting more interesting. These two big players in Asia are leading the way in growth. Their success affects the whole world. In 2024, everyone is watching how India and China compare economically. Policymakers, investors, and experts want to know what makes these giants tick. This deep dive will look at the important numbers and trends that show how these two countries stack up. Key takeaways: detailed analysis of the economic rivalry between India and China in 2024, exploration of growth patterns, market size, manufacturing capabilities, and other crucial economic indicators, insights into the factors shaping the economic landscapes of these two Asian giants, comprehensive understanding of the dynamic relationship between India and China's economies, significance of this economic comparison for global economic trends and policymaking, understanding economic growth patterns. 2024, over the last 20 years, India and China have seen huge economic growth. This has changed their economies and the world's economic scene. Let's look at their GDP growth, the impact of reforms, and how their growth rates compare today. Historical GDP growth trajectories: since 2000, India and China have had impressive GDP growth. China's economy has grown from $1.2 trillion to an estimated $15.8 trillion by 2024. India's GDP has jumped from $476 billion to a projected $5.2 trillion by 2024. These numbers show the big economic strides both countries have made. Economic reform impact analysis: economic reforms have been key to India and China's growth. China's reforms, like privatizing state-owned companies and opening up to foreign trade, have been crucial. India's reforms, like easing foreign investment and introducing GST, have also boosted its economy. Current growth rate comparison: recently, the growth rates of India and China have been closely watched. China's growth has slowed, but India's has kept up a fast pace. In 2024, China's growth is expected to be 5.5%, while India's is forecasted to be 7.2%. This shows their different paths in the global economy. Looking at GDP growth, reforms, and trends gives us insight into India and China's economic journey. These two countries are major players in the global economy. GDP and market size overview: when we look at India and China's economies, their size matters a lot. Both countries have grown a lot in the last 20 years. Their nominal GDP and purchasing power parity, PPP, have grown a lot. In 2024, China's nominal GDP is expected to be around $16.5 trillion. This makes it the second largest economy after the United States. India's nominal GDP is expected to be about $4 trillion, making it the fifth largest economy. But when we look at purchasing power parity, things are more even. China's PPP is about $29 trillion, while India's is around $12 trillion. This shows a big difference in living costs and what people can buy. Looking at market capitalization, China's stock markets are worth about $10 trillion. India's markets are worth around $3.5 trillion. This big difference shows how big China's economy is compared to India's. This data shows how big the difference is in India and China's economies. China is way ahead in nominal GDP, purchasing power parity, and market capitalization. Manufacturing sector: battle for global dominance. India and China are fighting hard to be the top in the world of making things. They've both grown a lot in making stuff, using the latest tech and improving their supply chains. This makes them big players in manufacturing. Industrial output metrics: China is a clear leader in making things, with its industrial production index higher than India's for 20 years. In 2024, China's making things is expected to grow even more. India is trying to catch up, using its growing talent and new policies to get better at making things. Manufacturing technology innovation: both countries are racing to use new tech in making things. They're investing in automation, robotics, and digital tools to make things better and faster. China is ahead in making electric cars and green energy stuff. India's startup scene is bringing new ideas to making things. Supply chain infrastructure. China has a huge high-speed rail and port system. This helps move goods smoothly in its big global supply chains. India is working to improve its transport and logistics. It's building new ways to move goods and make things better. The fight for top spot in Asia's making things world is getting intense. Their smart moves, new tech, and better supply chains will change the future of making things. This will affect the whole world's economy. Foreign direct investment landscape. India and China are the top spots for foreign direct investment, FDI. They draw in a lot of global capital. It's key to look at their FDI scenes and see what makes them so appealing. In the last 10 years, FDI inflows to both countries have gone up a lot. This shows they are open to business and have good policies for investors. Investment policies in India and China have changed to offer better deals and easier rules. This makes them more appealing to foreign investment trends. While China has led in FDI inflows before, India is catching up. India's new policies and openness are drawing more investors. Both countries keep improving their investment policies to stay ahead in the changing foreign investment trends. Digital economy and tech innovation. India and China are leading the digital transformation globally. They are changing the tech innovation and startup scenes. Both countries have growing startup ecosystems, attracting lots of investments and talented tech workers. Startup ecosystem comparison. India's startup scene has grown a lot in recent years. It now ranks third in the world. Reports show India has over 60,000 tech startups, with more unicorns in fintech, e-commerce, and software services. China is known for its tech giants like Alibaba, Tencent, and Baidu. Digital payment systems. Fintech is changing how people pay in India and China. India's digital payments market is set to hit $1 trillion by 2025, thanks to Paytm, PhonePe, and Google Pay. China's mobile payments, led by WeChat Pay and Alipay, have over 1 billion users. Tech workforce analytics. India's IT workforce is set to grow to 5.8 million by 2027. It's becoming a key player in software development and digital transformation. China's tech workforce is also impressive, with over 4 million engineers and programmers. This fuels China's tech strength. The digital economies of India and China are set to keep growing. This growth is thanks to their thriving startup ecosystems, innovative fintech, and skilled tech talent. India versus China economy comparison. Key indicators. Looking at India and China's economies, we need to check key indicators. These include inflation rates and income per capita. They help us see how well each country is doing financially. One important indicator is inflation rate. China keeps its inflation rate low, around 2.5% lately. India, on the other hand, sees higher and more unpredictable inflation, about 5.5%. This difference affects how much people can buy and the economy's stability. The unemployment rate is another key economic indicator. China's unemployment rate is about 4.2%, while India's is 6.8%. This shows China's labor market is stronger, offering more jobs. The income per capita also matters a lot. China's income per capita is around $10,500, much higher than India's $2,100. This income gap shows the economic differences between the two countries and the challenges India faces in raising its citizens' standard of living. By looking at these key economic indicators, we can understand the economic differences between India and China. This helps us see their strengths, weaknesses, and where they can grow and improve. International trade and export strategies. The global economy is more connected than ever, with trade being key for India and China's growth. These two giants are fighting for more of the global market. It's important to understand their trade strategies. Global market share analysis. India and China are both trying to increase their share in international trade. China leads with over 13% of the global market, while India has about 2%. India needs to boost its exports and offer more products to get a bigger share. Trade balance statistics. India's trade deficit with China is a big worry. In 2023, India's deficit with China was $75.9 billion, up from before. India aims to balance its trade and cut down on Chinese imports. Export diversification. Both India and China know they need to diversify exports to not rely too much on a few markets and products. India is growing its exports, focusing on pharmaceuticals, and farm products. China keeps leading in electronics and machinery but is also investing in new areas like green energy and electric cars. India and China must keep improving their global market share, trade balances, and export variety. These efforts will be key to their economic success in the long run. Infrastructure development and investment. India and China are racing to build better infrastructure. They see it as key to growing their economies. Both countries are working hard to improve their roads, cities, and public spaces. Public investment in these areas is a big deal for both governments. China is spending a lot on big projects like high-speed rail and new cities. India is upgrading its old infrastructure and working with private companies to do it. China is way ahead in infrastructure spending, but India is catching up. India plans to grow its roads and cities. This competition will keep pushing both countries to do better. Demographic dividend and labor force. India and China are changing their economies fast. The number of people working and their skills are key to their growth. Looking at who works, how skills are developed, and labor costs helps us understand their economic strength. Working age population trends. Both countries have lots of people ready to work. This is called a demographic dividend. India's working age population will be 67.5% of its total by 2024. China's will be 68.1%. This means they can use their people to grow their economies. Skill development programs. India has started many skill development programs. These include the Pradhan Mantri Kaushal Vikas Yojana and the National Skill Development Mission. China focuses on vocational education. It has more vocational schools and training centers than ever before. Labor cost analysis. Both countries have low labor costs. India's average monthly wage in manufacturing is about $300. China's is $500. Currency strength and monetary policies. The Indian rupee and the Chinese yuan have seen ups and downs in recent years. India's Reserve Bank of India, RBI, aims for a stable exchange rate and fights inflation. China's People's Bank of China, PBOC, uses different methods to keep the yuan's value steady and boost its global role. Both countries have faced currency volatility, but in different ways. The rupee has dealt with global market ups and downs. The yuan, on the other hand, has become part of the International Monetary Fund's, IMF, special drawing rights, SDR, basket. This move has made it a key global currency. India and China keep working on their monetary policies. The strength and stability of their currencies are key to their economic futures. Investors and policymakers worldwide watch these developments closely. The Indian rupee and Chinese yuan are important in the global financial scene.